Hello and welcome to Chapter 19, Foreign Exchange Markets. So, foreign exchange is basically a price, and the rate essentially is a relative price. So it's like apples versus oranges. One currency is quoted in terms of another currency. So you can either quote apples in terms of oranges, in other words, how many apples you get per orange, or you can just flip it the other way around and say how many oranges do you get per apple. So in that sense, exchange rates, and this is really key to understanding them, exchange rates are relative prices. So let's do some basics of exchange rates. If the demand for a nation's currency increases, ceteris paribus, the currency goes up in value. In other words, that country's currency becomes more valuable. If the demand decreases, that country's currency goes down in value. The language we use is that it depreciates. So when the dollar appreciates, in other words, goes up in value, it means, of course, that the dollar buys more foreign currency than it did. So in other words, the amount of euros that each dollar can buy go up. The amount of Indian rupees that each dollar can buy goes up. Whatever foreign currency we're talking about, the amount that it can buy in terms of the foreign currency goes up. Of course, what that means is the flip side of that as well. That means in terms of foreigners, if you live in Europe, then it means that the amount of dollars that the euro can buy goes down. Similarly, if you live in India, it means that the amount of dollars that an Indian rupee can buy goes down. So as the dollar appreciates, in other words, becomes more valuable, in other words, buys more foreign currency, it means US-made goods selling for a fixed price in the US, if they're exported, they become more expensive. Whereas, on the other hand, because each unit of foreign currency converts into a lower amount of dollars, it means that imports become cheaper. Once again, ceteris paribus. Of course, what that means is that when the US dollar depreciates, if you look at this, it means that imports are going to become less expensive, so we move down the demand curve for imports. That means the amount of imports we import goes up. Similarly, as the dollar appreciates, it means that exports, the amount that the US sells abroad, is going to come down because, of course, we're moving up the demand curve for exports. So it's a higher price as far as foreigners are concerned when it's converted into their currencies. That means they're going to buy less. So as the dollar appreciates, exports go down, imports go up. So in other words, the trade balance, which is exports minus imports, goes down. Obviously, everything is reversed if the dollar depreciates. The dollar goes down in value. It means that goods that are priced in dollars suddenly look cheaper to foreigners, so it moves down. They move down the demand curve. That means they buy more US exports. It means that US consumers buy less imports. So as the dollar depreciates, the opposite of that second bullet point, then it means that the trade balance is going to improve because our exports will increase and our imports will decrease. So, obviously this is a general rule. So it can be generalized to any currency. If the currency appreciates, exports get more expensive, imports get less expensive, ceteris paribus. it means the trade deficit worsens. Improves. Sorry, worsens when it appreciates. When it depreciates, it means the trade balance improves. So appreciation of the currency, trade balance deteriorates. Depreciation, it improves. So who actually trades in the foreign exchange market? Well, there are 4 types of participants. The largest by far are the banks. They buy and sell foreign exchange for their customers, but also basically for themselves as well, particularly the large ones. They speculate in the foreign exchange market. Brokers also buy and sell foreign currency. They act as intermediaries between the banks. Customers, these are mainly large customers, so large companies, they require foreign currency in the course of doing business or making investments. So you find that multinationals tend to be in the market for foreign exchange. And if you're a really big company, you probably have your own foreign exchange department in your treasury section of the company, the accounting section, accounting and finance section. And that's where large companies will do the foreign exchange transactions. Central banks also trade in foreign exchange. They act on behalf of the governments, and they sometimes participate in the foreign exchange market in a big way. So why do these participants exchange or trade currency? Well, if they're doing it for speculation, which is usually banks, brokers, rarely do you get large companies speculating, but sometimes they do. But if they do, they're there to earn these short-term profits from fluctuations in the exchange rates. And if they're companies, often what they're doing is they are in the foreign exchange market to protect themselves from losses resulting from changes in exchange rates. Often the large company will want to make sure that any deal that it does is protected from any foreign exchange rate movements. So for instance, if Boeing sells a bunch of planes to European airlines, then these European airlines may want to pay in euros, in which case Boeing will probably say, yes, we'll allow you to pay in euros. But at the same time, Boeing wants to make sure that whatever the price they agreed on in euros translates when it's changed into dollars into a certain amount in US dollars, preferably the US price. So in order to do that, because oftentimes the contracts for delivering planes are signed, years before the actual planes are delivered. So Boeing has to go into the foreign exchange market and basically hedge its risks. In other words, try and find some way to offset if there was a movement in the foreign exchange rates that hurt Boeing. Of course, if there's a movement that benefits Boeing, then that will be fine too. So let's just look at that as an example. If Boeing was going to sell planes to European carriers and they were going to pay in euros, then clearly Boeing would be worried if the euro essentially went down in value against the dollar, because as the euro fell, it would translate into less dollars. And that doesn't help Boeing, because Boeing is a US company. So that's the type of movement that they want to protect themselves from.